morning. This is George Kachuk with RCM Wealth Advisors reporting to you from the CME Group trading floor in Chicago. Well, here we are in the second week of October, and the equity markets are experiencing a little bit of a short-term correction. Of course, if you're a long-term investor, the long-term trend is still up. Maybe nothing you need to be concerned about, but the shorter-term traders, the markets are getting a little volatile and have been correcting. So let's review what's going on. Well, basically, we've seen a lot of distribution, the S&P and the NASDAQ, and the Russell 2000 pretty much led, that's the small cap index, led the market down to the downside. Most technicians were concerned with a head and shoulders top forming in the Russell 2000. We talked about this week, but actually last week it was able to hold that neckline break, stay above its earlier year lows of 1082. It's above 1100, so maybe it'll hold. Now the NASDAQ pretty much undercut its support levels, which we're talking about with 4,500 to 4,485, and traded down to its February high, 4,371, and bounced off that level. So that's a pretty good sign of support. The S&P's still flirting with support right around that 1975 level, although it did trade down to 1926 last week. So what's a trader do at this point? Well, for the short-term trader, we want to see if there's some confirmation. Basically, last Wednesday, the market just got destroyed. High volume, everything sold off very hard. On Thursday, the market in the morning continued downward, undercut Wednesday's lows, recovered, and made some upward progress. A really nice rally. The only problem was that the volume was lesser than the volume we saw on Wednesday when the market sold off, but the volume was above average. And Friday, we saw another really nice rally on all the indexes across the board, but again, the problem was we didn't have the volume. So what we're doing is we're waiting for the so-called follow-through day. What a follow-through day is, it confirms that if a market has a reaction off the bottom, it gives us some confirmation that institutions and the big money stepping back into the market. And what constitutes a follow-through day is, on day 4 after a rally attempt, or day 4 through day 10 or further on, if we see an increase of at least 1%, maybe 1.2, 1.4% on any of the major indices on a pickup in volume, that confirms that possibly a short-term bottom has been reached. And the significance of this 4th day rally attempt is that often if markets get sold down very hard, as they did last Wednesday, it's only normal to see a reaction, rally to the upside, or so-called the proverbial dead cat bounce. So we want to see if this bounce has any staying power or if it's just a mere reaction. And that's why if you wait till day 4, basically all the noise, sort of just the oversold reaction rally, will let us know that whether the rally was for real or it was just a bounce. So this doesn't really mean that you should be in a sell signal mode right now, even though the market's correcting, because a lot of leading stocks are holding up very well. However, this is a time problem. You should be off margin. Wait for the follow through if you're going to go in heavier. Also look to see how the leaders are acting. So far, the leadership continues in the same sectors we've talked about many times here. That's in the biotech sector, the medical drug sector, the generic drug sectors, in the hospital sector. Internet sector is doing very well, the security software sectors. Now we're seeing some consumer discretionary plays do very well, as the apparel sector is starting to do well, and the restaurant sector, industry group. So keep an eye on those industry groups with the higher relative strength that continue to hold up. Let price and volume be your guide. Look for that follow through, and good luck trading. This is George Kachuk for RCM Wealth Advisors reporting to you from the CME Group trading floor.